class, I'm required to say we're not making specific recommendations and, this is educational, all that kind of things. And the thing about Edward Jones, I'm not going to get specific as to them or I'll get sued, but when you deal with companies like that and they're very dominant in this area, the problem that I have is when you look at the investments for companies similar, Fidelity, the same thing. When you do an account at Fidelity or Edward Jones or Ameriprise, you tend to have more of their internal products offered, right? And there's nothing wrong with the companies making money off you. That's why they're here, right? But if you buy a mutual fund or an exchange-traded mutual fund, somebody set that up and they get a management fee, fair enough. Some fees are low because they don't do much, and some fees are high because they're doing a lot. These companies, like the bigger institutional firms, when you go work for them, their advisors are trained that they will use as many of their internal funds as possible. When you look at those funds, in my opinion, the ones that I've seen, their fees, management fees, are fairly high. And to me, a high fee is anything over 0.35, then we're getting up there. Because 0.05, it should be generic, vanilla, S&P 500 fund, Vanguard, Fidelity, Schwab, everybody keep the cost super low because they're just buying one of everything. It's like you give somebody a grocery list, go to Whole Foods and buy what's on the list. That's all they're doing. But if you say, me, go to Whole Foods and take another couple hours to figure out, Bill would like this, Bill would like that, and then the fee's going to be higher, right? So when these companies like Edward Jones, Ameriprise, Fidelity, and a lot of them, when you go directly to them, they want to have as many of their funds in them. And it's possible, and we may or may not have time to look up, but you might want to just Google the name of the funds that you have, each one, and see what the expense ratio is. And if it's lower than 0.1%, great, but it might be just a generic index fund, that's fine. We use a lot of them. If it's 0.35, then it's a generic index fund where they change the allocation a little bit and they do semi-work for you, right? Or if it's above 0.35 up to maybe at 0.5%, it's more custom. So it's like if you're building a house, neighborhoods where every other house is exactly the same, and that's a generic index of houses, and that's what you're getting. That's Vanguard's index fund or somebody else. But when you want a custom house, you're going to pay more. The problem with these companies that I mentioned, they'll have funds that have an expense ratio of 0.50. Okay, what are you doing for that? Not much. But they'll have 0.65, 0.75, 0.85, 0.95. They're way up there. And if they sold these funds years ago, 5 years, 20 years, 30 years, and they had higher expenses, if the investors aren't leaving for lower expenses, then they just kind of whistle past the graveyard and not say anything, and you keep paying high expenses.
Can you tell from the sticker, like all Vanguard starting with a V, all Fidelity start with an F? Is that true?
Close, possibly, but not 100%.
Not 100%.
Yeah.
So you can't really identify one of these companies by the sticker code. You really need to.
Yeah, a lot of Vanguards will start with an F, a lot of Fidelity with Fidelity with an F, Vanguard with a V. However, just Google it. And Google the name of the fund all the way down to XYZ fund, and if there's an A or a B or a C after it, okay? Because a lot of those funds, and that's why we'll look at stuff for people and then send you on your way if you'd like, and we can sit down, look it up, and say, oh my gosh, this is bad, or wait, this is pretty good. But companies like the ones we mentioned, why would they have the lowest cost when they can charge higher fees and nobody objects to it? When you have an advisor, if it's an independent advisor, he or she's going to try to put together a portfolio that has the lowest expenses possible. So when they add their 1%, it's not outrageous. But if they're charging 1 or 1.1 and you've got funds with 1%, now it's 2% and that's too high. So when we do portfolios, one of the biggest objectives is among these 10 or 12 funds, let's get the funds expenses really low. So if we add ours on, then it's fair. But these other companies, they don't care about, in my opinion, the advisors as much. They just want the advisors to bring you to their funds, invest them, and if they can keep the expense ratios fairly high, but the advisor is a really nice person, and if you're not digging into that, you'll be ending up paying high fees for years and years. That's why you want to have an assessment of that. And if you want to just go and look at your statement and Google the symbol and or the name, or the symbol and the expense ratio, you can find it if you want to. If you don't want to do all this stuff, then you hire an independent advisor that isn't have to do Fidelity or these companies that we mentioned. When you have an in-house advisor, they have a select of funds that their company says they can use, and many of them are encouraged to be their own because they have a high fee. And if the advisor charges a fee and the company gets a management fee, isn't that a conflict of interest?
Well, yeah, it sounds like I'm not very, it's pretty biased nesting too. It sounds
Yeah, usually
it's the best interest of you.
exactly.
If you're going there with your money, you don't know much and they're just not giving you the best deal.
So she mentioned it's not in your best interest, which gets us back to a fiduciary.
Right.
Now, can't an advisor be both? Because an advisor who sells an annuity may not be acting in a fiduciary manner. Is that possible to let a person, one advisor, does fiduciary and a non-fiduciary at the same time? That doesn't sound right either.
Yeah. Well, the new laws for advisors, brokers selling stuff, or advisors charging just a fee. One, the advisor selling stuff, if he or she is not a licensed advisor for a fee, because they can do both. They can go sell a product and say, okay, see you later, bye. It was appropriate at the time. It was fair. It was in a reasonable level. Because the things we're talking about are illegal, and they're fair. They're not outrageous. I don't think Edward Jones charges 1% on everything. They probably have reduced some of them at a fair rate and some a little higher. And we're talking 0.25% or a hat. To me, that's a big deal. That's my selling point. But to the regulators, that's not that much of a big deal. If I can always forget the name, the government part that regulates retirement plans, they don't let Edward Jones put all their own funds in there. They have to use other companies. So can they do both at the same time? The SEC and FINRA, the regulatory agencies, now have something for the brokers that is called best interest. They have to give you a form and say, look, we have to do everything to your best interest. It could have a commission in it, but it has to fit your particular needs. You have to want to be there, because if you buy a mutual fund with a 5% commission and then you sell it next year and buy another one with a 5%, that's ridiculous. But if you buy one with a 5% commission, you hold it 10 years, that's only 0.5% a year on the original investment. Maybe it grew and it averaged down to something really low. It's all relative, but the regulators are on your side now. We have to do what's right for the client at that moment. And there's all the little checklists to make sure that they're doing the right thing. As a broker later, if they're licensed with a big registered investment advisor, then they can call themselves an advisor. But if I call myself an advisor, ER, or an advisor, OR, I have to be registered through a registered investment advisor who is regulated by the U.S. SEC. Smaller ones by the state. So for the most part, it's not egregious, and I don't see, if you go through actual legitimate business people, it's just that if you have a lot of proprietary funds and your expense ratio is 0.5% a year, and you could bring that down either by doing it yourself or dealing with an independent advisor to bring the cost down, that's helpful. And when you have an advisor working for a big company, the company tells them what they will and won't do. And if they approach you with annuities and things, I don't like that. The annuities, in my opinion, unless there's a specific need for something like that, isn't appropriate, because the eternal fees that's hard to see are quite great over a long period of time. So don't worry if you have an Edward Jones account. If the advisor is doing a good job, then ask the advisor, what's the collective cost of the fees? Do I pay a commission going in? And then all you deal with are the fees on the product, or are you a fee-based advisor and am I paying Edward Jones a fee to manage the funds? And if I am, if somebody hires me to manage their money, it's my obligation not only to do the portfolio based on risk tolerance, time frames, and appropriateness, but for me to go shopping for the lowest cost funds if and when I can find it. Now, if you tell me that you've got to have a Bitcoin fund, like we said last week, okay, that can have a higher expense ratio. But what are you doing for that fee? I just want to put those people to work. So you just have to step back, flip through the book, in this class, and then there's 12 others there, and become more aware. And if you want to lift the lid to change your own oil, go for it. If you just don't want to be bothered, then you can pay 1% a year and get the lowest cost funds for that particular need, and feel good about it. Because there's things we all do that I'm not getting up on the roof and doing in a roof. Cost me, what was it, $11,000 to do a little roof repair on my building down the street. That's a lot, but I'm not getting up there to do it. I'd make mistakes, or it's too hot, or it's too dangerous. So we have to make that decision, but very good questions. Here's the beginning of the second class, and we want to go into some of the overall stuff, if I get this right. These don't apply to us. This is our Sac State class.
There's like 27 minutes.
Yeah. Yeah, we put this up at our Sac State class that starts on the 5th.
Yeah.
We had a 12-week class at Sac State. What time is it? 1 o'clock? Yeah, the Renaissance Society is a bunch of retirees that go out there. We have the only serious class. Most of the classes are, travel, Bob Dylan for 12 weeks. I even figured that. Politics and everything you could think of, and then there's cars. But I've done it for like 11 years or so people like it. So we put all these numbers up there because we have other people there. We make them watch a little video on CPR. So if I drop over, I want you to know how to do chest impression.
Everybody needs that.
That's my son, all his credentials. He teaches a class at Sac State. I'm his assistant because I don't plan to retire anytime soon, but he's my backup, the younger people, Shaniqua, my son, and so on. That's me, all the credentials and stuff. Then we get into the flyiness. Phase 1. In addition to looking at the investments, what's the point of having a very successful investment if, in fact, you had a lawsuit and you lost it and you didn't have proper insurance? Or what's the point of having that investment and if you pass away, you forgot to change beneficiaries of a prior marriage type thing? So we're going to talk briefly about what we talk about in what are called diagnostics. The first thing is obvious: income and expenses. We're all dealing with that on a daily basis. But with all the computer subscriptions and all that stuff, we encourage people to go back to whether it's Apple or somewhere else and see who's charging on a regular basis, because we're all paying $2 a month for something we're not even thinking about. And that's how the scammers get us, is on the little tiny fees that you don't notice. Or just look at so go back and recycle everything and try to save as much as possible. And the other fun thing is, if you're retired and you want to have conservative portfolios, and I don't want to risk everything, if I go back over my cash flow and I save $100, that was money you didn't have before. You can take that money and buy into an S&P 500 fund and hope and do it every month. I hope next month it crashes. Come on, crash, because I'm buying it cheaper and cheaper, right? Or, if you have a mortgage and you are paying whatever, the old mortgages, you might only be paying $1,000 a month. People ask me, should I pay it off? Absolutely, if you want to, because then you can take that $1,000 a month and buy up and down because you don't miss that money. And are you going to lose money in the stock market? Historically, no. Going forward, I doubt that very much. More people are being born every day and needing goods and services, right? So why would they not go shopping or buy anything? We could have a natural disaster, and that's a whole nother story. But generally speaking, in the long term, in my opinion, long term is 10 years or more. After that, stock market's going to be back and up, only because you have a lot of people needing goods and services. The financial planning part is, what do I do in the next 10 years if something in the market is a serious problem? How do I manage that? And we talked a little bit about last week, we'll talk about a little later, was managing the emergency fund, the balance funds, and the growth funds type thing. So cash flow, however you want to do that, just look at everything like a business owner would do and clean up the books and find any money that you can avoid paying. Insurances, we don't spend much time on this, but the bottom line is without it, what good are the investments if something happens? Obviously, on the house, your insurance is quite expensive. If there's a fire, they have to replace it. They also make you buy, if it's within that cost or condition, liability insurance. And when I was on the FAIR plan, I talked to the lady and said, okay, I got to buy liability insurance. Well, that replaces something like if an airplane crashes on my house, they'll replace. Well, I thought that was the fire part. No, that's a different policy. It's just crazy. And I don't know that there's any other options, but I did come off the FAIR plan and I pay about $1,000 less. Some of the insurance companies, they have reserves, right, in the holding to cover the losses. If interest rates go up like they did in the last few years, they're making more money on those reserves. And so when they have losses, they have the reserves and the income to balance those. So it's possible that some of them may come back to the market because they're making money and they can sell these policies again. I don't know. I'm only in Newcastle. We had oak trees, not pine trees, but still, we have to cut them all down into the house now. So a medical, obviously, just review what you've got, and then long-term care, disability. Pass this on to younger people. They need disability insurance. If you have it and you're paying premiums, I would keep it. If you don't, then you plan to self-insure, meaning live the healthiest lifestyle you can, not just to enjoy life, but not to have something like a dementia or whatnot. And you can watch a lot of videos from doctors and scientists and see what we need to do to stay healthy, because that's the biggest risk, right? If you have a physical ailment, you could get some assistance a lot cheaper than if you need somebody to keep you from escaping walking on the street. So, disability insurance, if you're working, mine's expired. I'm over 65, but and I have long-term care only because I don't want to use up personal assets. If there's two people in a relationship and you have long-term care, absolutely keep it. If there's one person left or only one person, you're primarily insuring against loss for your beneficiaries, not so much for you because you could use up your assets. And most people go to long-term care for 2.5 years and that's it. They expire. So look at things like that. I'm not saying go out and buy long-term care, it'd be too expensive. There is a little trick there, though. If you have an old annuity that you absolutely hate, somebody sold it to you, and for a while there, interest rates fell and you were getting 4%, but now rates are 4 or 5, and I don't like this old fixed annuity, there is a trick where you can do it with a legal exchange into a long-term care policy. And it's an all-cash policy. And the reason that the companies do that is they want to earn all the earnings off it and then just put your money in. If you're incapacitated, they'll use your money for the first 2 years, hoping you won't survive. Then if you live longer than that, they might use theirs. So if anybody has an old annuity out there, you don't need it, you could transfer that and create a long-term care policy. Life insurance, if you still have it, great. If you have a partner or a spouse, I wouldn't drop it. Why? As soon as you drop it, you die, then it was a big mistake, right? If it's outrageously expensive, you don't need it, that's fine, get rid of it. But if you have some term policy that hasn't expired yet, but they'll usually expire at 65, 70, and the premiums go too high. But I don't like life insurance, but if there's a need for it, then I love life insurance. I don't think I have any more. I think they've all expired and gone. But you want to self-insure and have your own money, right? And again, if you have a spouse or a partner, then keep it. But if you don't, why do you really need it? If you want it to make sure the grandkids get some money, great. But it's optional at that. Then we look at homeowners replacement costs, deductibles, all that stuff. Obviously, high deductible to bring your premium down. But that's going to be painful if something happens. Auto insurance, this is an area that people miss. You know how you got liability insurance, like $500,000 if you cause the accident? Well, most people that buy the $500,000 are responsible, and they're usually not the person causing the accident. So there's a level of coverage that the insurance company, and this is legitimate, doesn't want you to know. There's an uninsured, underinsured modes. So if somebody hits you that has no insurance or not enough, your policy has to cover the difference. In California, I think they have to give you 30 and 60,000 like coverages. But if you have 500, raise that to 500. Premiums will be a little bit more. But I've had one client, one student back in the 80s, I encouraged him to raise it to 300,000, both the liability and uninsured motorist, riding his bike, gets hit by a car, broken femur, in the hospital. The agent brings him a check for the bad debt hitting, $15,000. That's all they have. So my client got to get $285,000 from his own insurance company. I had to sue him because they didn't want to pay. But uninsured/underinsured motorists. Now, is that important for you? It's less important for you than it is a young person. Why would that be? Why would you not need the $500,000 tax-free money a little less than a young person? They don't have the resources you have, hopefully, one. And then two, they're going to live a lot longer, hopefully, right? So if you had a 20-year-old that's disabled because somebody hit them riding their bike, and they're disabled for life, and the bad guy or gal didn't have any coverage, they have nothing, right? So if this is why we want to encourage younger people to get the high liability so they can get the high uninsured, underinsured motors. And for them, they need disability insurance if they're working. And for them, they need travel insurance, probably up here somewhere. Travel insurance where if they get hurt on a trip somewhere, they can be shipped home and not cost mom and dad $50,000 or $100,000. So boring with topics of insurance, but it's the most important area that you got to cover first. And look at all the areas of liability we have listed in the book. Not a lot of fun to think about, but if you don't have those coverages, you're going to spend your money. Long-term care, if you don't have it, fine. Self-insure, be healthy. But if you do have it, it's going to avoid using up 100, 2, 3, 4, 500,000 if we had a long-term care issue. And then research those and find out what type of long-term care issues are predominant in the field, and is there any way I can try to be healthy and avoid it, or not, do dangerous things.
I mean, liability, if you have an umbrella, how do you know how much umbrella coverage to have?
Good point. We don't. Usually people say, I'll get an umbrella that covers my net worth, let's say. But if you park your car on the hill in San Francisco and the brake comes off and rolls over 10 people seriously ill, and they sue you for $5 million collectively, and they win, the attorneys are going to look up your net worth and find out what you have. And they're going to determine whether or not they're going to work for these people and go after your assets. In California, you have up to $600,000 of equity in your house that's protected. So if somebody sues you, if your house is $1 million, they could force you to sell it, give you $600,000, they keep $4 million. So it used to be the homestead in California was $100,000. Now it's $600,000, depending on the neighborhood. So that, if you have a house worth $600,000 or less, I don't need an umbrella liability policy. My house will protect it. If you have a rollover 401k into an IRA, that usually retains its lawsuit protection, so they can't take that from it. They can try to get the income, but they can't take the principal from you at that point. If you have assets that are just a brokerage account or a bunch of mutual funds or rentals, those are not protected. So now we need to buy the insurance policy. And it's a good idea. Everybody says get $1 million policy. Well, maybe more. But that $1 million policy will require that your auto and your home insurance have at least $500,000 liability on it. Why? Because that liability policy for $1 million wants the auto and home to pay the first $500,000. So actually, when you buy a $1 million policy, you're really only buying an additional $500,000, because they're going to make those. If it happens at the house or the car, they're going to make them pay the first $500,000 at that point. It's not all that expensive. And if you have a fair amount of assets, I would get a 1, 2, 3. I have a $5 million liability policy. And it covers a broad things: driving home, golfing, something else. If you hurt something, they get protected away. So take a look at all your assets. I'm just going to guess total net worth, although you could subtract the home from that, if the first $600,000, all that kind of thing. Okay, so estate planning. Are you guys familiar with wills and trusts and all that, or have any background? Okay, so you can pass this information on for people. A trust obviously is for physical things that aren't tied in a certain way. So if you have a bank account at the bank and you have it's in your name, you have a beneficiary, that's done. It's going to go to the beneficiary. But if you have a bank account that doesn't, or if you have tools or jewelry or something else that isn't titled in anything, you can put a general statement within the will saying, so-and-so gets all my collectibles and all the things that are left over after the trust. So I have a will that says, give these things to everybody. The problem with that is if you have more than like 100,000, then you have probate that could take a couple of years, and you have probate fees and all the problems with that. But that's the simple part. And that's either for you guys, for your physical items, and it's called a pour over, all the things that aren't covered in your trust. But for younger people, it's a good idea if they have a child, because the will can say if husband and wife or partner and partner died, then so-and-so can raise this child and take over him, I think. And I don't want to get too complicated, but there's a trust will that these people could say, if I die, go ahead and set up a trust for my kids. So that's the will part. For you, it's just a pour over if things aren't covered in the trust. The trust itself, as you know, you set it up and it's got all these instructions and things. If you have a partner, if both of you perish, or at the death of the second one, the trust then is looked at by whoever the backup trustee is and says, what do I do with this stuff? And then they follow the instructions. Now, the items that come in the trust have to be titled in the name of the trust. If they're not, then the will kind of backs that up. So if you have a house, that should be in the name of the trust. If you have a general mutual fund or brokerage account, that should be in the name of the trust. If you have bank accounts at the bank that are fairly large, that should be in the name of the trust. If they're smaller, they could be in the name of your trustee, just so he or she could get to that. But most everything that's fairly significant that doesn't have a beneficiary provision is in the name of the trust. And so I have a trust, I have a 28-year-old son, I have a fair amount of things I've been saving for 50 years. If I'm gone today, he doesn't immediately inherit everything. Most everything's held in the name of the trust, and he doesn't get control of it till he's 50 years old. Fine. Now, if he needs to use this to run a business, he can use this office. If he needs something to do something, but he's not given a bunch of money just to sit around and not work. That's my opinion. You may think otherwise. And that's the fun part about a trust. And make sure that when you're working with somebody else, if they do the trust for you, that they listen to your needs and expectations. Because attorneys tend to do boilerplate. Okay, the kid's going to get it at 18 and then some more money at 21. And I have all these attorneys all stomping on the table. No, that's not right. And I said, shut up. I paid you a lot of money. My kid's not getting it till he's 50. Now, if he gets certain credentials in this business, I'll drop it down to 45, down to 40, and then he can be the trustee at some point. Although he probably won't want to be, because then now he controls it. If he gets sued, they can get it. If it's an arm's length transaction and he has a trustee, they can't get it. So that's up to him. But he doesn't have access to it until he finishes several things. The last one will be a PhD. So I'm kind of hard on him about that. So, but why should he get anything? He's never been getting anything. He's gotten income and bonuses by getting all those credentials you saw. But I don't believe in giving things to people. We get jealous of them, say, oh, you inherited all that money. No, it's that. It's not good. I met, I think, Robert Kennedy's son in the administrative part of the county jail. I came in to work there, pick up all my supplies, go meet the inmates on a work site, and I see this guy laying on a bench, handcuffed to it. So I kick him. We don't want to do that today. Get off the bench. And he goes, and that was Robert Kennedy's son, not the one that's we know of, his brother. And he was here to take drug coaching and counseling, got in trouble, had to do the work project, and then he's being booked in. So that was very disrespectful. And so he ended up being a nice guy. But the moral to that story is he was given like 100 and something thousand a year, didn't have anything to do. And then you focus on my father was murdered, and then you're bummed out, and then what does he see? Drugs. So I feel sorry for him at that point. He ended up overdosing and died. So pension. So I don't believe in giving people money right away, but you could have incentive programs. Get this degree, money management program, whatever, and that will be kind of fun. Anyway, the living trust should, every asset that doesn't go directly should be in the name of the trust. And if it goes directly to somebody, make sure that's still appropriate. You could leave it in the trust and have it be there and help that person over time. That's up to you. But beneficiaries will override a trust. So if you have somebody there that you no longer want them on there, or maybe they're super successful and they don't want that much liability, then you could keep the trust as a trust on the side, and then they could manage it for their kids. You need to invest the money properly because the tax rates on a trust are quite high, but you could do municipal tax-free bonds, and you could do index funds and things like that. So there's a lot to it. Large trust, you want to have very specific instructions, beneficiary designations, those are going to override it. Insurance policies, go to beneficiaries. Most insurance policies, you get the money tax-free. Transfer upon death, that's kind of nice. So if you don't have a trust, you can do a transfer upon death in California if you don't see any need to go spend a bunch of money on a trust. Trust could cost $5,000 if you use an attorney, maybe $2,000 if you use a paralegal, and maybe a few $100 if you go online. You could do that if you want to. But it's a good idea if you don't need the trust to at least have a beneficiary provision, and for California real estate, it's transfer upon death. If you're married, it should be in the name of the trust if you have it. And if you don't have a trust, it should be held in community property. So there's a difference that if a married couple owned a house that was in joint tenancy, they bought it for $100,000 100 years ago. So they paid $100,000, right? And now it's worth like $1 million, right? If a husband and wife, the husband dies first, let's say, and then the wife says, I can't live here, I've got to sell the house. His half is free to her. So his half of $50,000 to $500,000 is tax-free. He got, but if she sells it, her $50,000 grew to $500,000 is taxable. And she can exclude $250,000, but she still has a big tax liability there. So we want to at least have the house and two people in the name of community property. So you waive that tax liability if one of you die, the survivor gets to inherit tax-free. So it's a lot of information, but either have the house in the name of a trust or as a transfer upon death. Well, married should be in the name of the trust or community property. And then if you're a single person, you're leaving it to one, it would be transfer upon death as .com. So all these other details get kind of deep. And if you have an account at one of these firms, they should be diving into this stuff. Either as a financial plan they charge you a fee for, or an hourly rate, or if you have money there, then they should at least look into these things and give you some helpful hints there. So that would be important. So we covered ownership of a house. If you don't have a living trust to leave the house to, if you're an individual, you want to have transfer upon death. If you don't want to go get a trust, make sure the house goes to somebody. If you're a single individual person. If you're married, you want to have the house in the name of the trust because it declares that the house is community property. And if the house is community property, then all of the gain at the death of one single partner or spouse, all of the gain is washed through. But if you own a house in joint tenancy, like you paid $100,000 for a lot of years ago, and now it's worth $1 million, then it's one spouse's half paid $50 and it's worth $500. The other paid $50 and it's worth $5. So if it's joint tenancy and one spouse or one partner, one friend or spouse dies, that person's $50,000 to $500 is tax-free. But if the survivor sells a house, they paid $50 and now it's worth $5. They pay tax on that $5. They get $250 exclusion, so they'll pay tax on $250. If you have an advisor at one of these firms, they should be looking into this stuff, or at least having an annual review and say, tell me about this, tell me about that. And then say, oh, yeah, it's the house is in community property. Yeah. If you're legally married, then you could have it in community property, avoid the tax. If it's in joint tenancy, you don't. And if there's a lot of gain, we need to worry about it. So we need to look at, what if you're disabled? As we retire, it's long-term care. What if we die? our partner or our beneficiaries, are they going to be set? And then what if I'm incapacitated? Do I have the structure and everything? Even to the point where some people are remodeling their house, I'm talking about, do you have a bedroom downstairs? Do you have plumbing downstairs? If we're successful, someday you're going to occupy that room, right? You don't want to be going up and down the stairs if you can. So those are some of the off the track items that the advisor should be aware of, thinking in the back of their mind, and then 10, 20, 30 years later, that comes to fruition. I had clients that I've had for 45 years. So we are getting foster. Pretty wild. Okay, so other things, durable power of attorney. If you have a trust, you likely have these documents, right? And they cover the what if I'm incapacitated temporarily or long term, right? Are you guys familiar with the durable power of attorney? So if you had a trust done, and if you don't have a trust, you definitely need these documents. That if you're temporarily incapacitated, then the medical one gives that person the right to have or refuse medical treatment for you within reason, right? They can't tell you don't get water or something. But if you were right on the brink and you gave them instruction to pull the plug, well, they could do that with a medical durable power of attorney or whatnot. The financial legal durable power of attorney then gives that person the legal right to manage your affairs while you're incapacitated. And there's one called, the word durable means that can last for a long time if you're incapacitated for a long time. And so they could manage paying your bills. If you're the only person in, whether you have a partner, spouse, or another person on the outside, they can manage your bills, or they could, if you were in the middle of selling your house and something happened to you, they could finalize that and then invest the money appropriately for your benefit when you get out of care and or while you stay in care. So that's a durable power of attorney for financial legal, and there's one for medical. So you're going to have two for each person in the situation. And that's, I find people say, I don't have enough to do a trust, and we own it in joint tenancy. If there's gain, it should be community property, but I'm not worried, everybody's a beneficiary. Well, what about you? If you're incapacitated, we need somebody who can step in and manage. Maybe somebody hurt you, and you need somebody to step in and sue that into and get some upfront money to help pay your care and negotiate that with your attorney. Some butts that you or something, the attorney might be able to get money up front in lieu of the settlement check. So that's important. But for younger people, it's important for young as well as older people. So pass this on to any younger people that you know. Okay, so estate planning examples. There are charitable trusts and things out there. If you want to set up a type of trust that says, look, this is for me and or my partner, but when the second person dies, you'd have trusts that can go directly to them. There's some that you can set up by naming them to get the benefits, to get the principal. You can start getting some tax deductions because you gifted that principal away. The only thing is you get the income until you go. That's a possibility just for fun. Direct IRA gifting, you can gift out of your IRA now to a charity if you want to. That helps reduce the size of the IRA and reduce your future required minimum distributions. But not everybody, if you're there to survive, is just getting money way left and wrong. But if you know of anybody that needs to do it, they can do it out of their IRA. There's donor advised funds. You can donate money to Fidelity, I think, has these. Put it into a donor advised fund whenever, $100 here, $1,000 there, and you gifted it to a charitable fund that you can decide who gets it later. So if you want to start building your charitable entity by donating money to this donor-advised funds, you can put money into it for the next 5 or 10 years, get a little deduction for each contribution, but you've donated it, you can't get it back, and then at some point in the future, you can decide, okay, I want XYZ legitimate organization to get this money, or many charities, if you ever wanted to do that. Charitable trust, same thing. You could set it up where it goes to charities, but you keep the income. And I think more specifically, the charitable remainder trust is the one where they're going to get the principal sooner or later, and you're going to get the income. Inheritance, family limited partnerships. We don't hear about those a lot anymore. Families like to get all their money consolidated in a limited partner. Then the kids might be a limited partner and get income someday, but they don't get control of the family trust. They just get the residual. And sometimes the attorneys aren't going to go after that because it's a big can of worms. If you want to protect assets, some attorneys will set up a family limited partnership, but then some judges will unwind it to say, no, you're trying to avoid liability there. Beneficiary transfer upon death, we talked about. If you have accounts that you don't need to have in a trust or you don't want to do a trust, I would highly recommend getting those done, and also make sure that you don't have somebody who is either passed away or independently wealthy, not deservedly, or ex-beneficiary. It's surprising to find out how many people would get things. We had one lady that married somebody that had a big retirement with the state or the federal government. And this person was convinced that when he dies, she's going to continue getting that. But he was married before, and he took a joint survivor benefit. And his wife, who would have continued to get it if he passed, she passed before him. So now he's getting that big wad of money, but he doesn't have anybody to leave it to because the first person already passed. This person married and thinking she was going to continue to get $6,000 a month or so. So it's a good idea to know what, if you have retirement, who's going to get it and for how long. And if it's your independent 401k rollover, you need to know, as we talked about before, how volatile has this been? If you're totally relying on all this rollover pension money that you're controlling, you definitely need to have that assessed and see what the historical volatility has been. And layer it in stages like we talked about. We want to plan for the worst case scenario. Whether it be man-made or nature, something's going to happen. We're going to have another big downturn because it's how everybody reacts to it, right? When you go to the ocean, the little ponds, and you touch the water, and everything draws back, right? When the little estuary, what are they called? Yeah, so they all recognize that you're there. They draw back to protect themselves. Something happens tomorrow that's not political or is, the market's going to draw back and people are going to get out. The computers are going to get out immediately. As soon as the market drops a certain amount down, AI is out of there. And that's not because they think it's the end of the stock market, let's get out forever, the world's coming. They want to get out here, and if it falls there, they want to get back in. And so they help make it a bigger fear, and also traders and speculators and everybody, they're getting out, hoping it'll keep going down so they can get back in. But if we as investors see it drop even more, oh no, I need to get out too. It's too late. So we don't want to do that. So when you have the portfolio laid out, if it's all the money in the world, if it's not just, that's there for the kids, you want super diversity like we talked about. I don't know if it's the right number, 10 to 12 funds. You could have more, you could have less. Different funds that have 50 to 3,000 stocks of bonds in them. I don't want any one stock or bond to cause me to go bankrupt. So in this portfolio, I want some of them, 5%, 10%, 20% of the portfolio are represented as immediate cash liquidity, meaning they won't be down. You could buy CDs, treasury bills, or exchange traded funds that have CDs and treasuries in them. And they're not going to drop in value if the market crashes because they're made up of T-bills. So 2%, 3%, 20%, whatever you want. Then part of the portfolio, if this is important money, is in a balance arrangement with funds that aren't going to crash. If the market drops 20, they might drop 8 or 9, but not as much. And so they might have stocks and bonds or very low volatile preferred stocks or blue chip stocks. And when the market does drop, they usually drop less. That's possible. I've only seen one time they drop more. Now it's kind of weird, but we know why. Then when we go on to the longer term, so this could be 2%, 5%, 20%. This could be 20%, 25%. And then the last percentage could be in more growthy stocks that in the long term will do much better than the first two in 10 years or beyond. But if the market crashes, they'll be down as much as the market, and you just close the door on that and look at what you have in the first two stages. Because the third stage, if you have stocks that have dropped as much as the market, in 2008, you were down 65% temporarily, and then the end of the year, you were down 50%. That was S&P. Now, if you had a blue chip stock fund or a balance fund, you were down less than that. But then you give up the upside, right? So short term, whatever percentage of the portfolio I can liquidate without any loss. Intermediate term, horizon, you're not stuck. You can get out of these anytime you want. But the horizon is I'm committing to these for, I would say, 3 to 7 years. Now, you can change your mind. Or if the market drops, and this is not a retirement portfolio, you could sell A and then buy B, the same thing, get a write-off, and then hope that B recovers. And then in the third stage, you're there for long-term inflation. Because anybody at whatever age, at 7, you could live 30 years or 30 minutes. We don't know. That's the tough thing about the investment process. So when we get into the allocations and everything, it's important to look at where we're going with the stuff. So inheritances, and you have revocable living trust, which most people have. Wills, we talked about. Special needs trust, obviously money put aside for other people. Asset protection, new marriage, prenuptial agreement, we all know about that. Irrevocable trust, you can have money go in. So in my case, if I died, my revocable trust turns into irrevocable, and nobody can touch it. My son can't take the money out or do anything. The trustee follows my instructions. My son doesn't own that trust, so if he got sued, it's not his trust. He owns the future income when the trustee decides to pay that, but he doesn't own the assets in the trust. So if somebody wants to, let's say you owned a massive business and you just sold it, you could set up an irrevocable trust where you're the beneficiary, get all the income and money you want, but it's irrevocable. So if somebody comes back after you, you say, sorry, I don't own those assets. And that's where a charitable trust comes in. You get into the charity, but say, well, but I'm the beneficiary, I get the income. So just for fun. And then limited liability corporations, those are interesting. They're only limited liability for the other partners, not for the individual. So if I own one LLC and I own all kinds of real estate, I'm protected. No, you're not. If I had partners, they're protected from my misuse and lawsuits. Their interest may be protected from somebody going after me and taking their part of the LLC, but you're not protected if you're a single owner in California. Some people go to Nevada, set them up. You still need to have other partners because California judges, well, it won't fly, from what I know. The tax area, and we call these diagnostics. We looked at cash flow and insurance and then taxes. We want to make sure that we cover all these. Tax-advantaged investments, what's that? If you have a retirement plan like a 401k or rolled over to a rollover IRA, that's tax advantage for a period of time until it's not, because you have to start taking money, pay tax on. Some views about that is if you could do a Roth conversion in a year earlier, that's nice, but you're going to pay tax. But the good thing is it'll reduce the size of this retirement plan, and it'll ultimately reduce the size of the required minimum distribution. So for some people that are, let's say, pre-70 or pre-65, then doing the Roth conversion is a pretty good idea because you can reduce the size of future liability tax. If somebody gets close to 65, if you start doing those conversions and paying taxes on the amount that you're converting to a Roth, that's nice, but your Medicare may spike for 2 years. So be advised that anything that you take for income, when we're on Medicare, the premiums could go up a little bit or a lot. So that's another thing I've seen these advisors make mistakes on. They get, hey, let's do a conversion of this Roth. Great, did you do a tax estimate? No, it's a good time to do it, but then all of a sudden the client's all mad that their Medicare premiums doubled. Because whatever income you have, they're going to set the premiums for the next year, the next 2 years, and you have to then say, look, my income's down, drop the premium. So those are little things that if you have a financial advisor, they have to be registered with a registered investment advisor. They can't just be somebody selling mutual funds. Can't call themselves an advisor. They're a financial, professional, but they're not an advisor. That's very critical, according to the SEC. Tax advantage investments include, if it's not a retirement plan, then in a portfolio, if you're in a high tax bracket, at least buy treasury bills, because those are state tax-free. If you got a bunch of money in CDs at the bank, or if you have a friend that's bragging about how much money they have in CDs, then you can say, well, that's great. You must like paying state taxes. If they itemize, treasury bills, you don't pay state taxes. So it's a good idea to consider that. And there are exchange traded funds that you can buy the fund that has 0 to 3 month T-bills in it, and you'll earn the interest state tax free, not federal. But to be more tax efficient in a big brokerage account or fund, the part that represents cash could be in the T-bills and save a little bit in the state, but the part that represents bonds, short-term, intermediate, we usually don't do long-term, but those can be municipal bonds, right? And if you don't want to buy one municipal bond and worry about, oh no, is that municipal going to make it? Then you can buy a municipal bond fund. So Vanguard has municipal bond funds that are fairly low or very low expense ratio because they're just buying one of everything. They're not getting in and getting out and doing anything. And they have some that are California bonds where you would earn the dividends state and federal tax free. But the downside is if you could get 5 on CDs and the municipal bond fund is paying 3, that's the equivalent of 5, but so you have to do your taxes and decide. Ask your accountant, should I go and hassle municipal bonds and earn 3, or should I buy taxable bonds, earn 5, but net 3? That's up to your tax review. But if you want to be as efficient as possible, municipal bond funds, because we don't want to own one bond, that there could be a risk, or that bond could just simply drop in value. Bonds don't have a stock market. You don't look up and see, what's the bond market doing today? We don't have it. The stock market has the Dow, the S&P, the NASDAQ, and probably 3,000 other indexes. And there may be some private indexes for bonds, but you don't see it. So if you own a bond fund and you want to get out and you make them buy your shares in a mutual fund, in an exchange traded fund, you just sell your shares to somebody else. The manager has to go, who's going to buy these bonds? And they usually have connections, and they say, hey, we got some bonds. They put it on the computer. These bonds are for sale. Hopefully somebody buys it. The risk of a bond fund, especially high-yield bond funds, what's another word for high-yield bond funds? Junk bond funds, right? Because their credit rating is low. So we got to distrust everything. High-yield bonds. Why is the high yield so much higher? Because the credit rating's not AAA, it's BBB or CCC. Higher risk of them going bankrupt, right? So when you get to high-yield bonds, great, they have 2% higher yields. I'm not going to get anywhere else. But I've got to be a little edgy and be prepared that the bonds inside the portfolio, it takes a little more time for the manager to buy and sell. So if the market drops, this bond fund might drop a little more because people are nervous and the liquidity's not quite there, right? Again, if you have an advisor, they should be talking about this and be very well aware. If you have an advisor that isn't, and they're a nice person and you want to keep them, send them to the class. Or they can go to our website, watch this stuff, because we have to be really, really knowledgeable in order to create a proper portfolio and in order to pick the right funds. You can do this by reading the book and doing the class or watching the videos, but if you have an advisor, they need to be on top of it. The other problem I have with these big companies is that the advisor or financial professional might not be the person actually picking the funds, actually doing the allocation. They might just ship the money to the home office saying, are you conservative? Are you moderate? Are you growth? And they might have a few other questions. And then that information goes to the home office. And then they just take the money and plug it into the pre-planned portfolio that meets that objective. Well, I don't mind doing model portfolios. We have some, but they're more specifically for that particular client. And that's what you should get if you're paying a fee to have your money managed, or do it yourself and pay that.
So on a bond fund, if you wanted to sell, the chances are that you have to wait for the fund manager to find a buyer.
No, you could sell very quickly. If it's a mutual fund, they have to buy back those shares.
Oh, they do.
Yeah, if it's an exchange traded fund, then you've got to find somebody else that buys it. Internally, if the funds are having a problem being liquidated because there's a big scare in the market, the price just goes down to represent that illiquidity. And now you go, what? What happened? Because we've seen some bond funds come out and say, hey, we're paying 9%. And then a month later, that drops 10% in value because some of the bonds in the portfolio couldn't be sold or one went bankrupt or something. So we already know if it's too good to be true, watch out. Anything that you buy that's publicly traded is already evened out to where that's pretty much what it's worth or what somebody will pay. If you want a deal that's better than everybody else, then you've got to be an investor that buys into a business that's unknown where you can lose your money. So the bonds themselves in a fund or an exchange traded fund or a mutual fund, they can drop in value, but that would just bring the overall share price down, which is why you buy a fund. If 1 out of 100 bonds went bankrupt, the share price might drop 2%. But if you just own that bond, you've lost everything, where the fund protects you in the fact that it's extremely well diversified. So that's why we insist on own funds, either a mutual fund at Vanguard, be careful with Fidelity and Schwab because some have higher expenses, or these other companies, or start learning about the exchange traded fund. The only problem with those is it's playing with fire, because if you buy or sell it in the morning, it might have changed by the later in the day against where you want. So that's a downside, but people like that. I'm going to buy it in the moment. What's it worth right now? And the expense ratios are usually lower than most mutual funds. What sets the expense ratio, in my opinion? Index fund where they're buying one of everything, the lowest. The next one where they carve it out a little differently and they rebalance it occasionally, a little higher. And then the ones where they're at it every day, then they're going to get the highest fee. But most mutual funds, in my opinion, there's been tons of them that started 50 years ago, and then 20 years ago, and 10 years ago. If they have mutual funds charging you 1.2% management fee, and on the chart they're no better than the average or even less, why would you own that fund? Well, because you're bored, you didn't look at it, you just trusted it's a good company and I didn't get around to it. And if you're the company, why are we going to drop the fee from 1.2 when nobody's asking you to? They're not demanding. So in my opinion, a lot of these companies just say, let sleepy dogs lie, or whistle past the cemetery. Do you guys know what that means? Okay.
I agree with that.
But if you've ever walked past the cemetery at night, it's a little creepy, right? So if you were walking past the cemetery alone, it's even more creepy. So in the old days, your parents would have laughed about you whistle and sing a tune while you're walking past the cemetery, so you're not thinking about the cemetery. Right? So they whistle past the cemetery, meaning they really don't do anything, just they hope it goes away, right? So if you have a mutual fund that's making millions of dollars, charging 1.2, and you're not the hottest thing out there, but nobody's gotten around to it because they bought it 20 years ago, I don't like that at all. Smart companies are reducing their fees, or they're keeping the old ones and then they're mirroring it in an exchange traded fund that has a low fee. Therefore, those people that are asleep will still pay it, and those people getting mad wanting to leave will just exchange it if possible, or sell it and buy this one, if they're wise. There's one company called American Fund. They didn't do these exchange traded funds for a long time. Now they have tons of them because they waited until the market said, look, if you don't start reducing their fee and coming up with new funds, I'm leaving. And so a lot of the old companies have their own line of ETFs, exchange traded funds. They could have converted the old mutual fund, but why won't you if you're making that high fee? Or maybe they charge 0.65. So I have a handful of higher expense ratio funds, but they better have a huge mountain chart reason that we're better than everybody else, or they're in a risky area like emerging markets or high yield junk bonds. I might hire managers to do that just to keep us out of trouble. You want a good management company that specializes in bonds, because when the market drops in bonds, they have good connections to try to get you the best price. So if you want a drama for the rest of your life, get into this business. It's fun because there's always something to worry about. So tax advantage would be municipal bonds and index funds. Okay, municipal bonds because they're partially and totally tax-free, ultra short-term, intermediate, and then index funds. Why is an index fund a tax advantage? Because they don't buy and sell. If you buy your shares at $3 and you someday it goes to $4 or $5, if you don't sell your shares, you don't pay any tax. An index fund doesn't turn money over constantly. They don't trigger tax system. Now, these other managed funds, they buy and sell, and you might get a big tax bill in April and be all mad at them because they just bought more shares. So tax efficiency would be mostly municipal bonds and index stock funds. Regardless, they buy one of everything, you just hold it, and they're not triggering taxes until you sell it. You'll pay the tax then, or there's a way to sell it and not pay any taxes, meaning you die and your beneficiary gets it tax-free. Which is a weird thing because we work all our lives. If something goes up bad and we sell it, we pay tax. But if you die, your beneficiary gets it tax-free. What? Yeah, that's kind of backwards, isn't it? So, tax-advantaged investing. Now, some people would say, none of these are tax-advantaged because you go in and you don't pay any taxes until the end. If it's a no-load, super low fee, sure, that's fine. But why would we do that? We've got municipal tax-free bonds. We've got tax-efficient stock funds. Very seldom would I think tax-deferred annuities are worth it. Unless you want to have a trust set up in a sense that you buy it for a grandchild who's terrible with money, and when they get to a certain age, that the insurance company owns the money and they give them an allowance. But there's a high cost for doing that. Tax credit investments, that would be things like low-cost housing. I wouldn't get involved in these. Those are more like limited partnerships where you give your money to a contractor and he or she says, I'll take care of your money and make you all this oodles of money. Well, if they could do that, why do they want to do that? There's a saying when you go into a limited partnership, you got to be very careful because the general partner has all the experience, the limited partner has all the money, right? But coming out of a limited partnership, the general partner has all the money and the limited partner has all the experience. That's what we want on board, right? So if you do anything like a partnership, make sure you do a lot of homework and it's extremely appropriate. Brokers can sell you a limited partnership that might last 3, 7, 10 years, and it may be appropriate at the time. I just would rather buy things like that by way of a mutual fund or an exchange traded fund, because one, you can see the popularity price every day, right? And you can put in a sell for that exchange traded mutual fund and sell out immediately. If you feel that, oh no, this is going to happen, get me out, a limited partnership, you might not be able to get out for years. And then when you do, it's possible that it's at a huge distance. So I would be very careful. They offer you a steak dinner, I'd run the other way. Just, I wouldn't get involved in non-publicly traded partnerships. Now, non-publicly traded partnerships where you and a contractor do it together and you're going to get your share back, if he or she is honest, you're going to make more money. The things we're saying here, we're going to make less money, but we don't have to worry about it being regulated and causing us to lose it at all. I'm not guaranteeing that you won't lose money if you sell it when the market goes down, and I can't guarantee a mutual fund would go bankrupt. I've just never seen. You're risking more of the market trends in funds than you are one particular stock going bankrupt. So in my field, I manage nest eggs. I can't afford to take massive risks. Let's buy this stock. It's going to go up. However, a lot of the portfolios that I represent own a lot of NVIDIA simply because that's part of the market. And so if they come in and say, well, I'm buying NVIDIA, you say, great, let's bring up, we have a report, here's your 12 funds, and here's a page that says, oh, you've got like 6% NVIDIA. You all, oh, good, okay, they're happy until it drops. But it's part of the overall market. So mutual fund versus exchange traded fund. We talked about that before. The mutual fund turns things over possibly. An index mutual fund doesn't, but it could be forced to turn money over if there was a mass liquidation. But generally, mutual funds buy and sell and trigger taxes for you on a yearly basis, and you find out about it in April if it's not a retirement fund. An exchange traded fund, they buy all the assets internally, you own the shares. Historically, exchange traded funds were more like an index. They didn't buy and didn't sell. Now, even when they do, though, because there are now managed exchange traded funds, they figured out a way to say, if we buy and sell this, let's trade our NVIDIA stock because we think it's overpriced. And in a mutual fund, if they sold it, you would pay the tax. But in an exchange traded fund, they have a rule here that says that they can trade NVIDIA for some other stock, same value, dollar amount, but we think is low, and put that in fund, and they don't pay a capital gains. You don't pay a capital gains. They traded that instead of sell. So the exchange traded fund is more tax efficient and doesn't trigger the tax effect. Now I say it may be. There are funds out there that will sell stuff and it does trigger. So you want to make sure you get an exchange traded fund that has a history and a mandate of trying to reduce the taxes or eliminate them as much as possible. Tax deferred annuity, fixed and variable. A fixed annuity is like, here, insurance company, here's all my money. Guarantee me a set rate of interest. Today it might be 5% when CDs might be at 4.5% or something. And they're getting to get us interested. They're looking at our greed factor. Well, I'm going to get 5.5, 6. But then when you read the contract, you have all these little things to jot through. That if you give an insurance company money in a fixed annuity, they're going to have a penalty phase that if you put it in today, and I think you have a right to pull it out within 30 or 90 units, but after that, if you pull it out, you could get hit their penalty. I've seen them as high as 20% or more. On average, maybe 10% within the first 7. So once you buy this annuity and then lock in whatever rate of return that sounds really good, now it's locked in, or maybe it goes up and down, but you can't get out of that annuity for, let's say, 7 to 10 years without a big penalty. Now, they need the penalty because they need to earn money on you more than they would have if they didn't have a broker or a salesperson. If they didn't have a salesperson, you buy an annuity, then the penalty to get out is maybe a year's interest or something. It's not going to be that bad. Maybe a little more if they commit to some bonds to give you this 5-rate interest. But the reason it's so egregious is they have to pay that advisor who just got 5-10% commission, or his or her home office. So if I need your money to come to me, the only reason I use advisors and brokers is to get them to send me their money, your money, have them solicit you to give me your money. So I'm this insurance company, I'm going to give you these nice little rates of return and all these little things to make it look nice, but I got to make enough off you each year to pay back the commission I just paid the insurance broker and agent. And we need to make a little more so we can pay ourselves, and we need to pay you. So that's why we worry that if they have a really high rate of interest, what's up with this? One, they might have higher risk bonds in the portfolio to be able to pay the broker, pay themselves, and then pay you. It's a round trip thing, so we want to be careful. You could find a no-load annuity. There's not many out there. I tried to find it because you would have to find them, bring them your money without the agent and work with them. And people just don't seek out insurance companies for annuities. So I wouldn't do an annuity unless you wanted to buy it, immediately start paying income for the rest of your life or somebody else's life, and you just don't want to worry about the market going up and down. It won't grow with inflation. It won't go down if the market crashes. But the downside is all your money's with one company. That's like buying one bond with one corporation. That's too risky. So at the very least, I don't like annuities because you've got all your eggs in that company. In 2008, we watched Hartford Common Stocks, Hartford Insurance Company, common stocks dropped 95%. Now it rebounded, but it was like, oh my God. Now they have reserve, but back then, if they hadn't bailed out AIG, annuities might have been lost for some people. The government had to back those. So unless it's, I need money immediately and I want somebody to give me an allowance for the rest of my life, or my disabled person, child needs the income, you buy the annuity, it's not going to grow, you're going to get whatever income they promised today and it's locked in forever, that's fine. But not everybody wants to tie their money up like that. So that's a fixed annuity. It gives you a set rate of interest. And they play with all these little ups and downs and all these weird terms that I've never heard of. So you got to be careful. If you ever looked at an annuity, at the very least, Google it and listen to some people talking about it. Not the salespeople, but XYZ, Google, why not to buy it or something. And that if there's a bad side to it, you might be able to find a good recommendation. I would stay away from annuities unless it's prescribed. It's in your financial plan, and this person is not good with money and I just don't want to give them the ability to invest it, then that could be, if it's prescribed within a financial plan, that's fine. But we'd rather have a no-load annuity, not one where they have to charge you higher fees to recoup the commissions. Variable annuities, just very quickly, you go with the insurance company, they set up an account with all these mutual fund-like similar investments, and then you get to be in the stock market. This is really great, and I can rebalance it, and if I had gain here or loss here, it doesn't matter, right? Because it's all tax deferred. It's similar to a 401k. You can move money around all the funds that they get a part of the management fee of, by the way. So they give you a list of all these funds, they get part of the management fee, and your expense ratio could be as high as, I see, 3% a year. So you have a variable annuity, all these separate accounts, they're similar to mutual funds. You put the money in, it grows tax deferred. If you die, your beneficiaries get back exactly what you invested. So if the market fell, they're going to be insured that loss. Not you, but your beneficiary. But the funds themselves might have high expense ratios in and of themselves. You might have 50 different funds to choose from. But when you combine the insurance, it's like, I forgot. It's like 1.5 or 1.75 mortality and expense. And that mortality and expense fee that they charge you is to cover your death. If you die, make sure your beneficiary got what you invest. So they charge you like 1.25, 1.5, 1.75. For life insurance, that is only the difference of your investment. I mean, if you put in $500,000 and it drops to $450,000, that 1.7% was only covering the difference. So if it grows, the insurance company is not at risk anymore. And you're paying this fee in case I die. Plus, the funds might have a 0.25 to 1% management fee that they get part of that. And if you pull the money out early, you get a huge penalty. And if you make money and pull money out, it's all ordinary taxable income. And if you make money and you die, your beneficiaries don't get the gains tax free. Like stepped up basis, have we heard that? So the variable annuity, all that, I see very few reasons to have it. There could be some exceptions. Tax-deferred investment vehicles, we all know the IRA, the 401k, you get a tax deduction going in and it's taxable coming out. And we talked about if you donated part of it, you just shrink down the size of this future tax liability. That will stay with a legal partner, spouse. If you die, they can roll it together. That's not a problem. If you don't have a legal spouse to leave it to, make sure that you have human beings as the beneficiary, not a trust, because if a trust inherits this money, it pays a lot of taxes when it pulls money out. So you'll have issues with that. So when you have a big 401k or IRA, and then somebody might say, just did a trust, should I put the trust as a beneficiary? Usually not, because if the trust inherits your IRA, it has about a year to pay the taxes, which could be quite high, 40% is the top rate. So we don't want to leave money to the trusts. Now, if you have a beneficiary that's not responsible, my son's responsible, but he was 18 when I set it up. I have a legacy IRA trust that my money goes to that trust. And he doesn't get it, but it does have to pull money out over 10 years and pay the taxes and then reinvest it in the other part of the trust. So if you have a living trust, be the beneficiary, unless it passes that money immediately on as IRA accounts, and it has to have that wording, you want to be careful about that. Try to make sure individual people are the beneficiary. If you have a legal partner, fine. If you're married, he or she can inherit it, not pay tax, just only on the required distributions, not on all of them. If you leave this money to me, thank you very much. I have 10 years I have to pull this money out. You leave it to a younger person, they have 10 years to start pulling it out. Leave it to a spouse, then they have the required minimum distribution based on their age, or possibly your life before you died. So 401k and all that stuff is great, but it's a future tax liability. We'll see a page here. Do I do a Roth conversion or not? That depends. Roth accounts, Senator Roth came up with this. As you know, you can put money in if you're working and your income is within a limit. You can put money in and it grows tax free. and someday you pull it out totally tax-free. Younger people can put money in a Roth, and they can pull back out their original contribution without a penalty, but they would pay a penalty on the interest, and they have to have that account there for 5 years. So there's all these little things. And the rules change every year. Converting your IRA to a Roth. You've heard of that. So should you or shouldn't? Here's some discussions about that. Reasons for converting to a Roth. You're retired and in a lower tax bracket. Okay, I'm in a lower tax bracket, and I want to reduce my future required minimum distributions and slowly let this thing grow tax-free. For my late retirement, maybe this is going to be the conversion that I do each year is going to be considered my late retirement long-term care policy. So each year I'll pull some money out of my IRA, pay the tax, convert it to a Roth, let it grow for the next 10, 20 years, and let it grow tax-free. So if I need to pull it out for inflation or long-term care, because not all long-term care is deductible, then I'm setting up aside some money for my long-term care, and you're self-insured. You retired late in years, and you can defer, later in the year, you can defer income. So if somebody retired in November, December, but you got the employer saying, look, we'll start paying you next year, right? And if you retire in November, December, then that's the time to convert some of the Roth, because you take that last few months of income that you're not earning, but they're going to pay you next year, then you can convert that much into a Roth. It's just a tax planning situation. And you take maybe a lump sum if you have vacation money. If you retire, or let's say in June of this year, and you got the rest of the year not to work, would your employer defer your retirement until next year and pay you vacation? Not all of them will, but if you could, this would be a good time to do this. Other reasons to consider a Roth conversion now, possible. If your individual income is $75,000 or less, adjusted gross, whether you get itemization or not, or if you're married to a spouse, $150,000, then you'll get $6,000 or $12,000 of tax deduction. We've heard that. That was the promise to say no taxes on Social Security. Well, they tried that. They weren't allowed to. Legal. They couldn't do it. So then they came up with something saying, well, the average person that's on Social Security to earn tax-free makes $75,000 for less, or $150,000 for couple. So if that person or that couple is at those rates, they get $6,000 of a Social Security tax deduction. It's just a tax deduction that they can use, or $12,000 of a tax deduction they can use. And so if you can use that $12,000 tax deduction and you itemize, that's great. You can use it. Also, if you itemize, the SALT tax has gone, you can deduct more of that. And we know what that is. That's state and local and state taxes. So up until now, if your property taxes are $5,000 and your state taxes are $5,000, well, that's $10,000. You get that as just a run-of-the-mill deduction. But if you can itemize and your state taxes go beyond that, they go to the total of the two go 15, 20, 30. You can deduct up to $40,000 of property taxes and state taxes. If you itemize and converting your IRA all at once or a big piece of it to a Roth, that's a good time to do this year, because if you see your accountant and say, can I use the $40,000 SALT deduction, because if I convert the IRA, it's going to increase my state taxes and my property taxes are already high, then you might have an analysis done and see if that qualifies.
That Social Security $6,000, that if you make it over 75, that doesn't even.
If it phases out, it phases out.
Yeah, no.
Yeah, if you go too far, yeah, you get none. But if you're up there, you're itemized, right? And if you're up there and you're itemizing, then you can use up to $40,000 of state tax. So last year when I did my taxes, property taxes represented 25% of that $10,000, and then everything else was state tax. But I actually paid a lot more, and I didn't get to write it off. So if you itemize and you have property taxes and state taxes above and beyond $10,000, call it a win, because you can go all the way up to $40,000. So if there was anything that was going to become taxable, now property, you do a 1031 and all that, but you were going to do a Roth conversion or pull money out of an annuity that you despise, and it's going to cause you to pay more taxes, maybe you can get some of that back if it's state tax deduction and property tax. Run a tax analysis, see an accountant or not, but this year, $6,000 per person if you qualify for the Social Security tax. If you don't, you just do if you do the standard deduction, you need another $2,000 person, so maybe $400 standard deduction if you can't do using best. But if you do itemize and you've got a lot of state taxes, all that kind of stuff, then you need to look at this and have a tax estimate back. Want to pay the conversion taxes for the benefit of future beneficiary. If you don't want the beneficiary,
Sorry, I have to go get some stuff.
well, that's okay. Are we up already then? So
It's the almost death. We could.
can you imagine if this was until it's over?
Yeah, but thank you very
Okay, great.
and I'll be here next.
Okay, see you next week.
You know,
All right, thanks.
trying to get through your book.
Oh, awesome. Okay, cool. See ya. Okay, so now it's until we're over. Then you'd wait another 8 hours. No, okay, I'll get 10 to shave.
Oh, no.
Yeah, I'm fine. If I should be a politician, I could be up here talking and all that stuff, right? So if you want to save money for the beneficiaries and or your future income will be higher. So your future income, maybe you're going to sell something, get that oil royalty or something 5 years from now, then you try to convert as many things as you can because you want to get out from under that future tax liability. Reasons against it: tax liability will move you up into a higher bracket. You don't have money for the taxes because you have to have money on the side to pay the taxes. That's the other catch, because you don't want to pull more money in just to pay taxes, right? Your taxes are not less than they were when you contributed to the previous plan. But most people are in a lower tax bracket in the future, so you could convert if you want to. But if you don't want to pay the taxes, don't convert. I mean, there's nothing pushing. If you're ultimately maybe reducing the size of your future required income distributions, and you're benefiting your beneficiary or beneficiaries, because they get to inherit tax revenue. But they have to take the money out over 10 years. You're not your spouse, but somebody else, even then.
So I would love to have someone do that analysis. Are there CPAs or planners that will do an in-depth Roth conversion for just an hourly rate?
There should be. Yeah, do you have somebody do your taxes?
I have a scout at CPA.
That one, very easily, you could say, look here, they should know, they should have the new state-of-the-art AI software. We have AI software, we plug in the tax return and it says, okay, based on everything you did, here's what you should. I learned when my son did an analysis and we bought the software and he ran my taxes, my CPA did a good job on everything, although the last 2 years they missed money, 401k contribution. We thought I had put it somewhere else for my employees. So I got a couple of big checks back from the government. But this AI software scanned it and told me that, okay, you use some money out of your health savings account to go to the dentist. While that's nice, you are aware that you pay state tax on that distribution. I didn't know that. So on a health savings account, if you use $5,000 for an implant, that's tax-free, except at the state level. But they tax that. That's like massive. I mean, you need it. Some medical care, right? The money I put in. But so I learned that from that software. Your CPA should very easily be able to scan your tax return and then tell you, yeah, here's your options, 1, 2, or 3.
And my tax return doesn't have my investments, the amount that I have in 401ks and IRAs. So the additional information I'll have to get that should be an email.
Well, you could say whatever you're comfortable with. Give them 3 loads. What if I convert 10 of that, 30 status, 50 back, whatever your high end is, the biggest amount that you would be willing to pull out, pay tax on that, and you had money on the side to pay the tax. So give them 2 or 3 scenarios, and then he'll give you 2 or 3 print. Now, he or she might charge a fair amount. That may not be that desirable, but you could look at the bottom line and say, here's what I had an income versus my taxes, and try to estimate that if I had another 20,000, how much will my taxes go? You could ask the accountant that. If my income goes up 30,000, what happens? And then they could just look at it and say, well, use this percentage and you'll pay that much little tax. But if you want to really get the bottom line, you could have them do your taxes. But it's one thing to help with AI. This is a real quick thing about the tax efficient investments. It's in the book, so you can look at this. If you find that you pay too much in federal and state taxes, what kind of things could I be doing or what I've done in the past? Step one, a tax-favored money market fund. Fidelity, Vanguard, they have a money market fund. The yield's probably quite low, 2.5% or so. But it's usually not going to fall much or at all, but they can technically fall. But it's a money market fund that you could have somewhere where you get a federal tax-free, some of them state tax-free also. Then the next level, and that's for money that you want to be able to write a check, so to speak. The next level is a tax-favored or municipal bond fund that earns 3.5, 4 tax-free. Now, bonds can go up and down a little bit in value, so if they're longer-term bonds, they can be more volatile. But that's where your savings account. So the bottom step one is your checking account, let's say, so to speak, your investments checking account. Step two is your investment savings account, municipal bonds. Step three are growth funds like the S&P 500 or other index funds that don't turn money around and cause you a lot of taxes. Step four is a tax-deductible or already done IRAs and 401ks. You have to pull some money out, but you just let them grow tax deferred, right? Most of it. Then the next one is personal residence. You already have. You have some tax benefits if you have a mortgage or you pay property tax. Step six, if you have or you want to convert to a Roth IRA, Roth 401k, these other Roths, and you want to pay the taxes to reduce your late retirement taxes or help your spouse out or help a beneficiary, then you're taking the tax hit right then. And when two of you are living, you get a little more of a deduction on the standard deduction, right? If you said, well, and you're still pretty young, but if you said, I want to set my wife up for a little bit lower tax bracket, you could start converting early on and letting her pull the money out later on a tax-free basis. But you might say, I don't want to lose that much to taxes. She'll combine it to you, and she'll just have more income to pay tax on. But she won't have quite the double dependency in that. Now, again, look at your taxes. Then above that, tax-deferred annuity, if you can find a low-cost, no-load annuity that doesn't charge fees and commission. Because that's just a savings account that's tax-deferred. I don't know why the banks don't do this, because you're going to go to the bank anyway. So you're going to buy the CD anyway. They don't need to hire their brief, I think, because if they did bank annuities that had no fees or commissions, and you just went in, and if you stay there, you get all the earnings tax-free, deferred. And the good thing for them is, if you cash out, you're going to pay taxes, so you better leave it with us. Feels like a tax-deferred CD account, but yeah, you can have it anytime you want. But if you do, you got to pay taxes. I don't know why they don't do it, other than they don't do their own annuities. Maybe it's a federal law that says credit unions can't do insurance products, but they make their own. But they bring in XYZ insurance company annuities who does charge a commission and does all the time to fees. So I guess we just figured that out. Commercial real estate like this, it's nice. I get to depreciate the value of the building, property taxes, all the expenses. Improvements have to be spread out over time, depreciated over time, but repairs to be deducted. And you can kick a tenant out and commercial if they violate contract housing without them. And the last one is personal business. Obviously, you have all those deductions that you can do at that point. Personal residence, loan points, mortgages, all this stuff. If you're retired, your house is probably paying for, but it's nice to pass this information on to other people. There's the California SALT tax. Now it's $40,000, which is property tax plus state tax if you itemize. Improvements increase the basis. You don't get a deduction if you build a new room on. You have to pay property tax on that. When you sell the house, you get to subtract that. And then stepped up basis, if your house is in the name of the trust and one of you pass, the survivor gets all the equity on both sides tax-free, not just the decedent's half. So stepped up in basis is what that is. And it's a good thing we didn't lose that in that tax law. Real estate tax deductions for rentals, those are all the things that we look at.